British people are not being told the truth about the real problems in their economy, and false problems lead to false solutions. We have been told since 2008 that the critical obstacle to overcome is the government deficit and the debt that it has built up. We have been told that the answer to this is cutting government spending, austerity. In this short film, we will explain firstly what the real problems in the economy are, and secondly, once those are understood, it becomes clear why austerity cannot possibly work. You cannot possibly balance the nation's books by simply cutting government spending. First, we need to understand Britain's trade deficit.
Britain's trade balance is not in good shape at the moment. We're running a deficit of about £40 billion a year, and that's made up of a surplus on services, but a much bigger deficit on manufactured goods. And that's why we have this very substantial deficit which runs on year after year. The problem we have is that every pound of current account deficit we have has to be financed by borrowing or selling assets, and that's what we've been doing for many years. This is why we've sold off huge quantities of our companies and our rail franchises and our property in this country to finance a standard of living which we're not earning.
The UK economy is very badly unbalanced. This is why it is growing so slowly, and why wages for many people have not grown in real terms for 10 years. Here's what's wrong. We invest much too little. We do not produce enough goods to pay our way in the world. To plug the gap every year, we sell assets and run up more and more debt. What growth we have is based on asset inflation and not trade and investment. We suffer from substantial regional imbalances and inequality.
One of the perennial problems in the UK economy is that growth can be imbalanced. It was highlighted by the financial crisis in 2008. That highlighted the imbalance and the over-reliance on the financial sector. In recent years, the imbalance has been very much seen in terms of both a big budget deficit and a large current account deficit. It's important to stress this is not new. When I started in the city in the late 1980s, then I was chief economist at Swiss Bank Corporation, and I pointed out in the Times that a UK trade deficit mattered more than a UK budget surplus. And I said the Lawson boom as a result would become a bust. And that was correct. And the reality is that ever since, we still try and wrestle with this problem. We don't save enough, we don't invest enough. So an imbalanced economy is a deep-rooted challenge.
We are told that the way ahead is to cut government spending. But austerity is not the answer.
Now, in terms of austerity, austerity doesn't work if it's the only thing you try and do. You can't squeeze the economy to be smaller. But we need to have a very balanced approach, because it's not only a large budget deficit, it's not only a large current account deficit, it's also the fact that the private sector, households, often against the backdrop of sluggish wage growth, accumulate large amounts of debt.
First, it is much easier to get productivity increases, which lead to growth and real wage increase, from manufacturing than from services. Second, most of our exports are goods, not services, and we do not make enough at the moment to pay our way in the world. Third, manufacturing jobs pay much better than too many low productivity, insecure service sector jobs.
If you compare manufacturing jobs with service jobs, what you'll find is that the average pay in manufacturing is about 25% higher than it is in the rest of the economy. Manufacturing produces about 10% of GDP from 8% of the labour force, which illustrates how much more productive it is and how much higher wages it can therefore pay. Well, as late as 1970, nearly a third of British GDP came from manufacturing, and then it fell by 1990 to about 18%, nearly halving, but then it's nearly halved again between 1990 and the present time, down to less than 10%. So there's been an enormous drop in the percentage of GDP coming from manufacturing over the last 30 or 40 years.
There is only one way to get enough manufacturing back to enable us to balance our books. We need a much lower exchange rate. The pound went down from about $1.45 to $1.25 after the EU referendum, and this is why the economy has done so much better than most people expected since then.
Well, of course, since the Brexit referendum vote, the pound has come off, but not as dramatically as some people think it has, and in fact it's improved a bit recently. It's about 1.30 against the dollar now. Well, it was about 1.45 before the referendum. Against the euro, where are we now? 1.16, 17? Well, it was about 1.20, 25 before the referendum. So there has been a devaluation. It's, what, 10% or whatever. I think this is wholly beneficial. And in fact, if you look at the survey information, whether it's the market surveys of manufacturing, or whether it's the CBI surveys, or indeed the Bank of England's agents report, they're all suggesting that actually export orders look very buoyant. This is a good thing.
But $1.25 is still too high to get most manufacturing resited back in the UK. For this to happen, we need to get the pound down to about £1 equals $1. Could we do it? Of course, we could, if we really tried. And what would happen then? Investment would pour into UK manufacturing to take advantage of new profitable opportunities. The economy would start to grow much faster. Wages would go up. We could balance the books and stop running up debts. We could invest much more in schools, hospitals, roads, and housing, all the opposite of austerity policies. So why don't we do it?
I think there's just been a long history in this country of adherence to both economic theories and sort of practical views about the getting a high value for your pound when you go on holidays, which have just blinded people to the necessity for making sure that actually we can be competitive in this world. And the only way of making us be competitive is to charge our costs out to the rest of the world at a lower rate.
Exchange rate policy is crucial, yet for many decades we have ignored this vital policy key to running the economy because of economic ideas which have had their day. And we ignore it because it doesn't suit certain interests to fix it.